The S&P 500 is now down more than 5% from its all-time high. And the bulk of Friday's sell-off came specifically from the tech sector. The sellers are definitely here, but could earnings from Tesla, Meta, Microsoft, and Google this week be enough to flip the markets right back in the upward direction? I would tend to think not, but let's answer that question more directly by looking through the data points and building a game plan for the week ahead. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe for 100K by May, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, solid red-bodied bar with a very impressive close from our sellers, dead on the lows of the overall trading range. So I think it speaks for itself, but I'll say it out loud anyways. Sellers are in control from a structural point of view. In terms of location on the bar-to-bar count, we do have a lower high as well as a substantial lower low. So sellers go 2 for 2 on our weekly count for the second week now in a row. And yes, this is a harsh change in tone. It's a sharp pullback. It's a volatile pullback, but let's not lose sight of the context in which it's happening. It's been a slow and steady grind. I shouldn't even say slow. It's been a very rapid grind in the upward direction for a number of weeks now, months now even at this point, and we are technically pulling back from the highest high in the trend cycle. We've been thinking about the opportunity of a weekly higher low to be found at 2 locations in particular. So let's talk about location number 1, because clearly we have closed underneath. So let's have a candid conversation here. This, of course, is a 2-week balance range. The top of that range acted as resistance, and we also know that coming in with a Fibonacci from the January low up to the all-time high gave us decent confluence here at the 38.2. The idea was that previous resistance with confluence had the opportunity to act as newfound support if buyers could step up around 502, 503 as a zone. They absolutely did not step up at 502 and 503 as a zone, and we have clearly closed underneath. So on the weekly time frame chart, we have to start thinking about what's the opportunity now that support has been violated for a lower high on any sort of rebound in the upward direction. And we can actually use this pullback over here as a direct blueprint. If we do something that looks like this, you get previous resistance having the opportunity to act as support in here coming from the highest high in that trend sequence. We closed underneath. We get a counter trend move, and this sets up, of course, nothing more than a lower high. So on the weekly time frame chart, how do we know whether or not a counter trend move is going to unfold? I would really just focus on last week's low. And to give you the exact number, last week's low is at 493.86. If you don't know where I'm looking at this box right here. L, 493.86 is the low of last week's bar. If we are above last week's low, I would look for the counter trend move. As you can see back here, we do not make a bar-to-bar lower low, and we move in the upward direction. How else can we get a counter trend move, right? You take out the previous weekly low, but you close back up inside of the previous week's range, ideally higher in the previous week's range, and then you get a counter trend move, right? So that's what we're thinking about here this week. Last week's low is your main gauge of price action. If we are underneath, we're looking for follow through in the downward direction. If we're above, we're looking for a counter trend move. Now, where might we look for a lower high on the weekly time frame chart? I would really focus on this level right here, which is technically 512.50. And we'll see 512.50 on the daily time frame chart, and we'll also see it here on the weekly time frame chart as a high volume node overhead. If we're underneath the previous week's low and we are moving in the downward direction, what's ultimately the target? It's pit stop number 2. 480 is very important because if we come in with a Fibonacci from the low of the October pullback up to the all-time high, the 38.2 is in this zone around 480. It's the top of this multi-week balance range from over here. And if we zoom out on the chart, just to remind you, right, it's the previous all-time high confluence as well. So we should absolutely not lose sight of 480 as a key level, even if the market appears to be free-falling on its way to get there. So that's the objective on the higher time frame. Previous weekly low is going to act as your judge of price action. If we come in here with a couple of additional studies to add some more confluence, let's join up with the anchored view apps. You can see we've broken down underneath the first anchored view app, and of course, now you're getting confluence at that 480 level. We'll check once again. Do the buyers step up here? If so, great. We are looking for a higher low. If they don't, we start to flip into a very neutral trend, and we'll take it one step at a time. That would start to suggest many more problems market-wide, which we would have to dive into at minimum at a sector level, if not individual company level. We'd be talking about a leadership shift at that particular point in time. So 480, very key zone on the higher time frame charts, checks out based on the anchored view apps. And let's also come in here with with our volume profile, just so you can also see the high volume node overhead at that 512. So as we were drawing it in, there's your high volume node. If we do get a counter trend move and reject here, it makes sense. This is overhead supply weighing on price in the downward direction. If you're like, Matt, what if we just set an arbitrary weekly high or low in here? Well, you would have to spot the daily uptrend and ideally just get back up and over this 512.50 area to print some sort of equal high or new all-time high. One step at a time. There's a lot of work that needs to be done on the daily if we're even going to remotely think about a new daily uptrend, right? And also just providing confluence at the 480 previous all-time high. This one's fairly straightforward. Obviously it's a high volume shelf considering that we've traded in this zone for quite some time, and all of this is new all-time highs. It's new price discovery, so not a lot of volume commitment at price, just reinforcing the idea that this would be very substantial on a retest of 480, also from a volume point of view. So that's going to do it on the weekly time frame chart. The last thing I'll leave you with here is a quick measuring stick. We talked about being down over 5% in the intro. Here it is. If I hover my cursor, you can see we're down just over 5.5%, 5.63%. If we were to make the pullback all the way to 480, what would that look like? Let's come in from the high down towards 480, something like this. That's looking like loosely an 8.5% pullback. One of the things I would remind you is that typically in a bull market about once a year, you get about a 10% correction. So is that well within the bounds of a normal, still bullish market? I think the answer is absolutely yes. On the daily time frame chart, let's firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 504.78, implying a lower high. And if we're contained by the lower bound, the number is at 485.52, implying a lower low. The trend is down, so this does strike me as a more bearish and basically expected, weekly expected move. If we're counting trend, we have highs, lower highs, lower highs, lows, lower lows, lower lows, and we're sitting on a massive lower low. So I would really reinforce the same ideas from the Wednesday midweek market update, which if you're not already short, this is not the time for a new money short. If you're short from up here on Monday, Tuesday's breakdown, even Wednesday's morning breakdown, then great. Hold them if you've got them. But if you don't have shorts already, I would not be fishing for new money shorts dead on the lows of the overall move. This is the sucker short. This is getting short in the hole, right? That's a terrible idea, risk reward wise at least. So if the market continues to extend in the downward direction, again, that keeps us underneath last week's low, I would be looking for lower high opportunities underneath last week's low. And once again, you could use this level. I think that this makes more sense based on the intraday structure at 494.25, or you could use the level that we discussed on the weekly. That makes sense to me. I would not be chasing shorts in here. I'd be thinking about where can we get the counter trend, and then how can we set up a lower high short entry with better risk reward up against that previous low. That's bearish continuation. If we do see a move that sweeps that low and then comes back in for a higher low, I would be thinking about the counter trend move that possibly sets up the lower high here at 503, right? So this would be the look below and fail on the previous week's low. Intraday or even intra-week, we find a higher low over 494.25, then the next lower high to be set on the daily, right, based on an hourly counter trend move, would be at 503. So those are really the daily levels that I would focus on. We can get granular now and just directly bring it on down to the hourly time frame chart. Obviously the structure was bearish. We closed dead on the lows of the Friday session, right? And you can see that we're just bear flagging in the downward direction. Here we go, breakdown, little flag consolidation, breakdown. It wouldn't be unreasonable to see some consolidation or even that counter trend move. If you get a rejection here, fine. You could look for a short up against that, but I would really consider this much more of an opportunity for balance. If you're getting this, it's an opportunity for balance, and I would be hard pressed to be an aggressive short underneath 494.25. If you get the stronger counter trend move on the hourly chart, something that looks like this, then this to me is the place to get short, as we just described on the daily time frame chart at 503, looking for a double top up here, looking for a head and shoulders up here, looking for a very simple inverted hammer up here. This is the place to get short with tight risk. Stop goes just above. You're very close to this week's expected move high. So the odds would sort of favor a move back down towards the midpoint, at least from an options hedging perspective, right? And you could start thinking about target number one, target number two, back down to the lows of last week's range, right? That makes sense here at 494.25. If the market does continue in the downward direction, let's talk about bearish outcomes first, then we'll talk about where I change my tone. But if the market does continue, right, I would be thinking about, all right, where's the double bottom here and how can I participate in this higher low? I would look for the counter trend move here. This is very interesting to me. Can we get that higher low as we were describing over the previous week's low, a failure from the sellers to get continuation, right? Sort of an exhaustion move, if you will. And then mind you, when we're talking about a long from here to here or even up to here at 503, this is counter trend. We're not talking about a market that's strong. We're not talking about a market that's going to all-time highs. we're talking about capitalizing on a counter trend move, and that's it. Even if you don't want to take this move, you have to understand the propensity for the market to move in the upward direction on a higher low over that particular level. I would not be aggressively trying to short this in here directly after a higher low over 494.25, right? So that is the downside. Obviously, the same type of thing can unfold here. I mean, if you want to be quick draw McGraw and try to pull off a scalp on a lower high here, targeting this, I mean, be my guest, but just understand that you do not want to overstay your welcome on the short side if this is your initial entry, right? You're just asking for the whiplash back in the upward direction. So anyways, same concepts down here, double bottom, great, looking for the counter trend move. And as we know, then we can set up the move for a lower high here. And maybe this offers better risk reward. If we're thinking about risk reward, maybe something that does this with a target back down towards these equal lows, right? That's a possibility. Again, very speculative as of right now. Where I would change my tone in the upward direction, where I would say, this is interesting. Why are the buyers able to actually achieve this? It really would require a clear recapture of this level at 505.65. Why? Because it's and by recapture, I mean a higher low. So not only would that be extended through the upper edge of this week's expected move, but it would be a move over 503. And why is 503 so important? Because on the daily time frame chart, we know that this represents the NVIDIA earnings gap and the two previous highs we were describing on the weekly time frame chart. So if there was some sort of miraculous recovery to something that did this, then great. I mean, that counter trend move can continue. And then what's the danger, right? What did we just describe on the weekly time frame chart? Of course, it's that 512.50 menacing opportunity for a support the idea for a counter trend move if we're over the previous week's low, right? Is that the point of control closed dead on the lows, or I shouldn't say dead on the lows, but very close to the lower third of that Friday range. So if we're over that, any shorts who are late to the party, those folks start to squeeze out. Now, I'm not going to sit here and deny the fact that, of course, we've made progress in the downward direction. Here's value area, here's value area, here's value area, right? Sellers are making solid progress in the downward direction, which once again, I would lean back on the comment we made on the hourly chart, which is we're just talking about a counter trend move. We're not talking about markets going and making new all-time highs. We're not talking about stronger buyers just suddenly showing up and ripping the market into new all-time highs. It's not the case. Sellers are here, right? So something that I could sort of envision is just the fact that we have this incredibly poor low on the Friday session low. If we need to repair that, aka a sweep underneath, then a higher low inside of range, that starts to set up ideas for the counter trend move in the first place. And once again, you could start thinking about what's the opportunity of a lower high here. And maybe that's around, we've been talking about 50.45 on the ES futures. If we just go back on over to the charts here, that would be basically the equivalent of this zone right here at 500, and not too far away from what we have here at 503. Right, so all over the place, we're looking for these lower highs to be set. I want to be very clear that the sellers have showed up. And based on the structure and based on some of the structural implications out of the sectors, I should say more intermarket dynamics, it doesn't look like earnings season is going to be this big saving grace. If we just take a quick tour through some of the sectors, let's actually go on over the QQQ NASDAQ 100. We'll keep this show on the road in terms of trying to keep it brief and succinct. I'll see if I can do this in one take here. Anyways, QQQ, hard to ignore the bearish pressure, right? Breaking down from that multi-week, I think it was a 7-week balance range, right? 7-week balance range has been released in the downward direction, and now the opportunity, the threat, as we described in last week's episode, very similar to the spiders, is a lower high underneath. If we do something that looks like this, of course there's a concern, right, for drifting into a downtrend. And this is a stretch of the imagination, but maybe someone out there is probably going to argue, there's your head and shoulders, right? We're underneath the neckline. Oh my goodness, we're coming back down into the retest, closer to this sort of like 385. So be it. That's fine. But on the weekly chart, I do believe that it's possible to get a little bit of support off of this range, right? If we look at what we're coming into, barreling into, we've more than doubled the range, which is always the range target on a breakdown, right? You look to double that range. We've more than doubled it. We're coming into a known area of possible support. If we bring out that Fibonacci coming from the low up to the high, and this is still a weekly time frame chart, there's your 38.2. So do you want to continue to push the bet for a short dead on the lows of this move after a very explosive breakdown in the downward direction? I don't think so. So like this 408, 410 zone we've been describing on the QQQ weeklies is still very much so in play. You could do the same thing with your anchored VWAPs here out of the QQQ weekly, right? We're coming directly into this zone. It is an anchored VWAP. We've already snapped this one. So like, again, the argument is not that the market's bullish, not that the market's, oh my goodness, new all-time highs are here, but this is a very real opportunity on the weekly time frame. Let's check in on the volume profile, and then we'll drop it back down to the daily time frame chart here. So anyways, this is a little bit underneath. That would be undercutting this area right here. I would tend to think that maybe that happens only if the S&Ps remain incredibly weak. It really depends on earnings here, specifically out of the NASDAQ side of things, but we're basically coming into this big shelf of support. I would really encourage you to be mindful of that on the NASDAQ side of things. Let's go to the daily time frame chart for our QQQ and see what's going on here. So the pain was really dealt, the damage was dealt via the NASDAQ into the Friday session. If you actually look at the sector lineup, and we'll briefly touch on this right now before we dive into the sectors, look at what was down the most. I mean, this sorting for Thinkorswim is absolutely god-awful, so I'm going to have a word with support. We'll dial them up on speed dial number 2. But SMH down over 10, nearly 11% on Friday, on the week session, and then the XLK down almost 7% on the week session, whereas everything else, like, don't get me wrong, it's still a bloodbath out there in the other sectors, but that's what's driving the move in the downward direction, at least on Friday. Look at Friday's session here, tacking on let's just call it 1.7% on the XLK, and the SMH well over down 3%, right? Whereas everything else was, I don't want to say, again, completely neutral, but not nearly as bad. So if the tech sector is oversold, and let's just continue to explore this concept, actually, as we're diving through the charts today and maybe telling the story a little bit more fluently than staying so rigid to our process. I mean, look at the XLF. It's seeing a rebound here, but if it just consolidates sideways in the range, that's going to prevent further pressure in your S&Ps. You would really require a new lower low out of the XLF breaking down from some sort of like bear flag in here if it's going to continue to dramatically impact the S&Ps, right? If we look at the XLV, the healthcare sector, this is a danger. I would certainly concede that this is a danger. So say that your XLK, which basically is a proxy for the QQQ, as we've already discussed, coming directly into support, say that the XLK finds support next week and sees a rebound. If the XLV healthcare sector actually breaks down underneath this descending triangle low, that would be far more of a concern, and maybe we do see further pressure out of the S&Ps. So relative to the XLF, I think the XLF, I don't want to call it completely safe, but this to me seems like it can more reasonably produce some sort of balance in here. Don't get me wrong, we're looking for a lower high. This is a breakdown, right? We've seen a move in the downward direction. We've taken out this area as well. This could easily set up a lower high on the retest of 40.45. But if it just consolidates sideways and does not make a lower low, then I think it's neutral for the S&Ps. Whereas compared to this XLV, right, if we snap this low and move in the downward direction, that's bearish pressure for your S&Ps, even if your XLK is going to rebound. So I guess the if-then statement ultimately is if the XLV snaps this low and everything else is neutral, it's probably not going to be an easy time finding longs in the S&P. If the XLV wants to sweep this, provide a fake out via a higher low back above, I'd be much more neutral and willing to be, open-minded to the counter trend move we've been describing so far in the S&P 500. So hopefully that wasn't too convoluted, but let's go over the XLK so I can give you the levels over here. Once again, look at the damage that's been done. Do you want to be short into this area of possible support? I mean, personally, I don't. This is not the time for a new money short. The time to be short was right here, right? As we were breaking underneath this very key and very obvious support. They even gave you, on the Tuesday session, a bearish 3-bar play, right? So there you go. There's another short opportunity. This is not the time to be short. That's another gist of today's episode of the weekly watch list, right? So understanding this at 193.50, I think is going to be paramount for navigating your S&Ps into the coming weeks worth of trade. If we do get a counter trend rally, I would be looking for a lower high up against this zone. I would be looking for rejections of loosely 197.50, 199.25, 200. Remember, this is the NVIDIA earnings gap basically. So a lower high in this zone is not unreasonable. That's definitely something that could happen, and it keeps the bearish pressure on markets. What are we thinking about? Like, how does that align with the S&P? Of course, there's your counter trend move. If we continue in the downward direction, if there is that obvious lower high off of that 503 zone, that's how we navigate down to that 480 stronger weekly area of support. So hopefully, to sort of put the pieces of the puzzle together, that's kind of how we're trying to navigate that, right? Let's go over the QQQs though. I know we have a lot of folks who are interested in trading the QQQs, so I'm going to give you a little bit more of a succinct breakdown of the levels here. We're coming into this area of support, which we just described, 412. This is not where we want to be short. We want to be thinking about double bottoms down here, inverted head and shoulders down here. We want to be thinking about hammer candles down here. If we can spot that, your lower high gets set where? Underneath this shelf. Right, this shelf right here at 423.50. I mean, could the weekly technically afford a lower high all the way up here as we were describing on the weekly chart? Absolutely, and that's 433.75. But unfortunately for the bulls, I don't really think that that's going to be in play for this week's worth of trade. I would instead think that this, like a retracement of Friday's session, finding weakness in here would be a huge tell. Now, once again, earnings are going to be the wild card this week with a number of heavy hitters reporting, namely Tesla, Meta, Microsoft, and Google. So we'll watch out for all of those names, and it's going to make it a very interesting week to say the least. But from a structural and technical point of view, this would be the number at 423.50. If we just quickly jump on over to the NASDAQ internals, what we'll see is basically the same thing across the board. Monday, really, really aggressive. Monday, really, really aggressive. Same thing over here. You do get a little bit more of an aggressive bearish tick on the cumulative build for Friday relative to the S&P 500. But look at your sort of, this move in here. Not strong volume outflows like we saw on Monday. Look at your advanced decline line, really tangled up around the zero line. So once again, when we're thinking about the opportunity for a counter trend move, are the sellers exhausted coming into this weekly area of support at the NASDAQ? I think that it definitely makes more sense to sort of take that line of thinking instead of saying, hey, no, this thing's just going to drill into the center of the earth. Like, I would dial that back just a little bit here. Let's move on over to the IWM and see what's going on over here, because this continues to reduce its tailwind effect for the S&Ps as well, and it sort of ties into the whole narrative as well anyways. So if we do this, right, we've been talking about the 199-200 area. The firm breakdown underneath does not help your S&P 500. And of course, the threat here is even on a counter trend move, you set up the lower high and you start to emerge with a weekly head and shoulders. So 199-200, big threat. Is it possible that this, and this are technically higher lows? It is possible, and we are technically coming from the highest high in the trend count. But being inside of this starts to make me think about a failed breakout, right? And we've been referencing the XRT recently, which of course is retail, back down firmly underneath its area here, and XBI, which is going to be your biotechs, right? Even more towards the center of the overall balance range in here. So I don't think that small caps are out of the woods. We know that this is going to be extremely sensitive to the PCE data, which is coming out on Friday. We'll get to the economic calendar stuff in just a moment as well. But here we go to the daily time frame chart. If we're thinking about what's happening in small caps, one of the interesting nuances here is that small caps, yes, they have broken down aggressively, but on Friday, they actually printed a green session, right? This is unlike anything we saw in the S&Ps or the NASDAQ. Everything was just straight red all last week in the S&P and NASDAQ, whereas the Russell has actually seen a little bit of two-sided trade taking place. So are we coming into a zone where maybe it's not going to be so straightforward that we're just going to, continue knifing in the downward direction? I think the answer to that question is absolutely. We can start thinking about some chop in here. If we take it on down to an hourly time frame chart out of the Russell, what we'll see over here is this inflection point is very, very obvious based on Friday's acceptance underneath, the lack of acceptance on sort of the midweek and sort of earlier week sessions. The sellers couldn't really get it underneath. So if we stay underneath 193.50, that would be a win for our sellers, and we would be thinking about bearish consolidation in here and a dribbling in the downward direction. If we can get over 193.50, I'd be very open-minded to a neutral sort of drift through this zone, but it's definitely not bearish for your S&P. So once again, if the NASDAQ is finding support on the weekly time frame chart and the IWM is also finding a higher low over this 193.50, I'm not going to go out on a limb and directly call this, oh yeah, it's this beautiful inverted head and shoulders, but at least it's not continuing progress for our sellers in the downward direction. So that level, once again, is at 193.50. And that's going to pretty much chalk it up for your IWM. We could take a brief look at the Russell internals here, and it's a whole lot of the same. So I don't think I have to repeat myself. You can take a look at the outflows and sort of outflows versus neutral, right? So we're all good on that front. One of the things I will do, and this has come from a request in the comment section as well, is just make sure I touch on the NQ market profile. I know that this is software that not maybe everybody has, although it's free. I mean, you can get this stuff for free, but let's just talk about it. And the idea here is that the point of control on, interestingly enough, out of the NASDAQ, actually did not migrate lower on the Thursday session. It did migrate lower, obviously, into Friday, but the sort of takeaway, I suppose, this is a really long-winded way of saying this, is that as long as we're underneath this, right, that is certainly an opportunity for a lower high out of our NASDAQ, and that's loosely around 17,650 on the NQ futures, right? The idea is that instead of recapturing the point of control, which maybe would have been, on a relative basis, if we look at the ES, it's lower inside of this range here, right? If we go back over to the NASDAQ, anybody who's short in the NASDAQ at the point of control, basically, they're okay. They're not really too worried about having to squeeze out if we're just getting a backtest and a retracement of Friday's move into this, again, maybe around 17.6-ish zone. If we get that lower high, I mean, these shorts are fine, right? The time when the shorts start squeezing out of the NASDAQ is possibly, I would say, the clearance of this as a zone up here, right? If we can clear that, that's really when it's game on. That's at 18,000 in your NQ futures. If we go back on over to the cash market here out of the QQQ, that would be the recapture of basically this level right here, 433.75, back into the balance range overhead. What have we been describing so far today? We're trying to acknowledge that stronger sellers are here. That's not really a primary outcome that we're aiming for into the coming weeks worth of trade. So hopefully that's useful in terms of talking about where those reference points are. We'll do the same thing for the Russell, because once again, based on explicit feedback from the comments, I'm trying to listen to the people, give the people what they want. So here we go. Over on the Russell, you've got the same different indication in which the point of control is lower. On Friday, we actually closed the point of control higher. We talked about this two-sided trade unfolding. It would make more sense to me that the Russell has an opportunity to move in the upward direction on a squeeze, which is basically what we just described based on the candlestick charts, right? If we go back on over here, this is getting a little bit too unguided now at this point. I think if I'm going to take this approach again next week, we'll have to rein it in just a little bit. But in here, right, this is where we're above some of those points of control, which are lower in those individual sessions, and it wouldn't be unreasonable for that move in the upward direction. All right. With the broad market covered for the most part, we'll jump into a couple of quick charts for supporting evidence. We'll keep it brief, right? If we look at the sector ratio grid, if you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is a concern, right? The staggering relative weakness of the XLK should be an alarm bell in your head. The relative strength of the XLF is like, okay, maybe it's not the end of the world. And we've already discussed this on the structural charts themselves, right? We were talking about how the XLF, if it stays sideways in that overall range, it's not going to be the end of the world if we're in here, right? And that's basically the reflection of what's happening in the relative chart. The XLY really needs to get into gear. If we're looking for a more risk-on opportunity to enter the market near the lows, you want to see improvements out of this chart, and it just has not been doing anything constructive for a very long while now. This is concerning from a risk-off style look. This is concerning from a risk-off look. This is concerning from a risk-off look. So I think it's very clear that there's been a change in tone. We've identified this over a week ago, right? You can go back, watch the videos, grab the timestamps. It's fine. It's all out there, right? The XLK versus the SHY, government-backed 1 to 3 year bond, this staggering risk-off style move here on this breakdown, right? So that, of course, is a concern. That's bearish. If we do the same thing here out of XLK, XLU, bearish look, risk-off style look. Let's take a look here out of apples to apples, XLP, XLY. This one has been stuck in a balance range for a while. Look at how it's made a decisive move, right? This, of course, supports the risk-off thesis. So even if we get a counter trend move and these things do not improve, I would be thinking about, all right, it's nothing more than a counter trend. We're looking for lower high entries. SMH XLV, same thing here. So semis versus the healthcare sector, looking for a lower high, right? Let's finish it up with some dollar gold stuff, and you can see that the dollar is certainly consolidating over the top of the previous balance range highs. If I really zoom this out to a multi-week chart, you can see here we're getting consolidation above is what you just saw on the daily time frame. So that, of course, is downward pressure for equities. Gold remains high and tight in this consolidation. If it pulls back, that's going to be upward pressure for your dollar, which of course is downward pressure here for equities. So continuing to monitor that relationship, but not overly concerned. Interest rates remain really hot, right? They're clearly staying higher for longer. And if we look at the inverted ZT, this is also staying higher for longer. So if this breaks in the upward direction, what do you think the Fed's going to have to do? I mean, not only is it higher for longer, but if we make a new higher high, and this is, very much so a stretch of the imagination as of right now. It's a possibility, but we don't have the data in front of us right now. If we make a new higher high, I don't know how the Fed couldn't raise rates in tandem with the 2-year, right? The 2-year basically leads the Fed for anybody who's maybe not well versed in Fed speak or understand as maybe tapped in. Let's take a look at the tracker tool, actually, since this is a very loose episode today. This is not what we want. We want the Fed tracker tool. There you go. So it's still higher for longer. No surprises out of the Fed tracker tool. No issues. And of course, this aligns with the move lower out of the markets, right? Why have we been talking about this? Because it's really going to require the repricing of earnings cycles and EPS for Q2, in my estimation. Here is what we had last week in terms of economic data. You can see that retail sales came in incredibly hot. So inflation-wise, that's not helping the Fed. And if we move on down to the bottom, you'll also see that unemployment claims, initial jobless claims, they're staggeringly low. 212,000, the expectation was 215,000. It's not even moving the needle. We're not even close to 250,000. So you can read about these Tesla headlines. Oh my goodness, Elon Musk is such a bad guy. He's laying off such a huge percentage of the workforce. It's not moving the needle out of the labor market. And if the labor market's robust, Jerome Powell has no reason to cut rates prematurely. Here we go. If we're looking at our contributions to, retail sales, what I wanted to point out here was gasoline stations, right? So, of course, this is sort of suggestive that people are spending money in the gasoline station. I'm not necessarily convinced that this is a direct correlation to gasoline itself in terms of the reporting, but if people are at a gas station, you would likely imagine, obviously, that there's some gas being pumped. So overall, what we're thinking about is energy inflation persisting throughout the summer months when travel is getting hot. Retail sales at gas stations is up compared to last time, right? You can see the increase. If you were just to do this on a relative basis, we are higher here out of the previous. You'll also notice that this non-store retailers is absolutely taking over. So people are going on buying sprees on like your non-store retailers, basically any online e-com, right? So buying sprees online, people have money to spend, it seems, and the Fed's going to look at all of this information. Do not be fooled by like, oh, we've got our dual mandate and we only look at the PCE. No, and I think Jerome Powell comes out and says this a number of times, but like they look at a number of different data points, a large, huge set of data points. And if you think that this is going to convince them that it's time to cut rates, I don't know what planet you're living on, right? That's just not going to happen. If we take a look at the earnings insight from FactSet, courtesy of the good folks over at FactSet, thank you guys so much for posting this. You'll notice that this week is huge, right? We're not going to get Amazon and we're not going to get NVIDIA, but Google, Meta, and Microsoft, 3 of the big 5 here, are basically going to contribute, or the expectation is at least, for 64.3% of the earnings growth year over year based on Q1, right? If there's any miss out of earnings from the Magnificent Seven, basically, again, I don't want to be doom and gloom. I don't want to say kiss the S&P 500 goodbye, but I don't really envision a world in which we clearly resolve this weekly pullback in a smooth manner if earnings do not go well. So keep that in mind. Here is the calendar for the folks who are maybe curious. There's your Tesla after the close on Tuesday. Meta after the close on Wednesday, Microsoft and Alphabet after the close on Thursday. The following week is when we'll get Apple and Amazon, and then usually NVIDIA, they kick the can way down the road, and they'll be much later in the month here. Let's go back on over to the platform, and we will do a speed round through, if I could find the platform, there we go, our risk indications. So TLT ratio to the S&P is moving in the upward direction, not a huge threat as of right now, but it makes sense based on what's happening in the market itself. Bonds continue to tick in the upward direction, no surprises over here. What we want to focus on are credit spreads here. As these move into uptrends, right, these were becoming hard to ignore. The big higher high, specifically out of short-dated SHY, HYG, is becoming even harder to ignore. And this is making sense as the market is breaking down. So if you're like, Matt, dude, you're doom and gloom, like, could you be a little bit more positive? I'm thinking about Mr. Regan in the comments section. You would want to see this move in the downward direction, like flip back into a downtrend and I'll be on your team all day long. But if this is elevated, if we're in an uptrend, I can't really say with confidence that things are fine and dandy in your S&P. HYG clearly moving in the downward direction as well. One of the things that supports the evidence for a counter trend move, hopefully you've made it to this point in the video. I don't know how long we're going for as of right now, or if this is even shortened at this point or abbreviated compared to normal, but look at your HYG divergence. We've actually closed for a higher low into Friday's afternoon versus the S&P down below. So ding, 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 yellow flag helping the counter trend move narrative for your S&Ps. You should be thinking about high yield junk bonds, right? Let's move into Bitcoin, see what's happening over here. Nothing good. It's just sitting at the bottom end of the flag range. I would tend to think if these hammers can resolve, you're just trading for the top of the range. This is technically risk on. I don't fully believe in Bitcoin being a flight to safety style trade yet. So you'll prove me wrong in the future, but as of right now, it's basically risk on. One of the interesting things about breadth is that if we look at the end of week, it actually increased as the market was moving lower. So once again, talking about the concentration in the breakdown of tech, breadth moving higher supports the idea that if the tech sector sees a rebound, it wouldn't be unreasonable for the counter trend move to actually unfold. If we take a look at the SPX A200R, it's technically lower or slightly lower on the week. Let's go to a SPX A50R on the daily, right? This is higher into the end of the week. So once again, thinking about the opportunity for a counter trend, breadth and the HYG, both of these things are supportive of this move for a lower high to be set. RSP is going to illustrate the same thing. There was no follow through on the Friday session, right? So when everything's equal weight and when tech is not dominating the weightings of the S&P, we basically just went sideways. So counter trend move totally makes sense to me here based on all the data points that I can see. Here's the QQQE. Again, tech weighted versus non-weighted. Of course, tech was the one that was blowing up on Friday, so no surprises over here. What about the Dow Jones Industrials versus transports? We did make a new lower low out of transport. So once again, this is aligning with the more bearish or dominating bearish narrative that we have on the higher time frame chart. So yes, once again, counter trends can unfold, but we're not out of the woods. This is not like, oh my goodness, all-time highs are around the corner. Let's move into some volatility stuff to wrap it up, and then a quick speed round through this, and then I've got a couple of ideas for you, two to be exact. Volatility moving lower on the Friday session, so VIX-free Fridays, right? Dropping there, but the market's still lower. So once again, concentration in tech. If this continues in the downward direction, I think you can still find a floor at 15 and remain elevated for a volatile market as we move through earnings season. That's totally a possibility, but if it's lower, that's going to alleviate some of the pressure in the S&Ps. Let's specifically take a look at the VVIX, which of course is volatility of volatility. It did not make a new higher high. So the VIX did, the VVIX did not. So that is a big takeaway here. And once again, supportive of the counter trend move. Let's quickly check in on our VIX futures. Vol futures, I've flipped these relationships. So you're usually used to me saying, okay, we're under the zero line. This is contango. Now we're above the zero line. This is contango. I think it just made more sense. When you're negative, that would seemingly make more sense to say, okay, now we're in backwardation. So anyways, quick update on that. Same thing over here. The one-day VIX is still elevated over that 1275. If we can get an open underneath 1275 on the Monday session and then start an ascent, that would be, again, another evidence or data point supporting the counter trend narrative. Let's quickly take a tour through the core list of companies here. Very, very brief. Apple is breaking down underneath our key level at 167. Lower highs can be set underneath. You're looking for a move to continue in the downward direction. Earnings are further out on this one, not this week, so not as much of a concern. If we quickly drop it on down to an hourly time frame chart, again, your idea is something that looks like this. Where's the lower high? Show me the lower high at 167. Next up, we've got Microsoft drilling to the center of the earth, but coming into a known area of support. Is it possible that you see a counter trend move ahead of earnings? A little bit of sideways. We're not sure what's going to happen here. I totally think the answer is yes. If we can hold up over 399, we're looking okay. Counter trend moves set a lower high under 404.75. The ideal line in the sand, so on a daily chart, right? A daily time frame chart, any lower highs here make the most sense to me. That's going to be at 414. Once again, earnings are on Thursday, so play with this one at caution. Same thing on Google. Earnings are on Thursday, so play the options chain with caution. This, of course, is suggestive of a head and shoulders unfolding, but if we take a look at the hourly time frame chart, one of the interesting things that you'll notice here is that we actually broke an area of support based on all of these interactions and did not get follow through. So Google, one of the more interesting names on that Friday session, getting a little bit of a rebound here into the close or mid-afternoon compared to move in the downward direction. So if we can hold this, I'd be thinking about where's the opportunity to, again, just rinse and repeat these ideas for a lower high at 155.50. I'd be interested in trading Google maybe Monday and Tuesday, but definitely not on Wednesday or Thursday. Moving along to Amazon, what's happening with Nancy, another one just drilling to the center of the earth. There you have it. So lower highs that are set anywhere underneath this level, 180, are in play. Earnings are not this week, they are next week, so push that off a little bit further. I think that you can get bearish consolidation down here. If it turns into a flag, I'd be really interested in lower high opportunities here for a closure of the gap underneath us there. Let's move along to NVIDIA, the one stock to rule them all. Not really ruling them all as of right now. What do we see out of the name here? Big breakdown of the head and shoulders neckline, right? If you're going to do something that looks like this, you're underneath that 841.50. I mean, it's just not there. So again, very obvious stuff. You're looking for a lower high underneath the level and then continuation to close the gap underneath. That is certainly an opportunity. Do you want to be short dead on the lows of the move? Again, I think the time to be short was on the breakdown here or around some of these lower high opportunities in here. If we go on down to the hourly time frame chart, there was an offering, right, of a bear flag in this zone. There was an offering of a lower high gap fill reversal. Not really a gap. We didn't open outside of range, but you can see in terms of this structural level at 841.50, look at the upper wick. Right? That was the time to get short. The time to get short is not down here, at least in terms of a day trade. So trying to take NVIDIA day by day, looking for lower highs. I know I sound like a broken record, but that's really the name of the game here. AMD, speaking of chips getting absolutely decimated, right? We know that the head and shoulders here is more severe. There is more of a prominent pattern, more of a prominent formation. We're underneath the neckline. We're moving down. I don't really think that there's much, again, I hate to be a broken record. It's basically the same thing. Look for your lower high and look for continuation. This is a major area that I would be watching for at 134.25. So I'm just going to, try to keep it simple here for the rest of the video, but that's out of AMD. And it'll be more granular. Like if you're like, dude, this is not very helpful, tune into the morning update on Monday morning at 8:15. We'll be live going over the pre-market prep anyhow. And I think I'm going to take that as more serious indication for these weekend updates. Like, if the pre-market prep's going to come out anyways, let's not spend too much time thinking about situations until we actually get to it, right? So I don't know, maybe that's a good idea, maybe it's not, and you're like, no, I only watch the weekend updates. Let me know in the comment section as some feedback. We're trying to give the people what they want. Again, in terms of hitting all the key data points that you need to know with the balance of not being over the top or doing things that people don't want to see, basically. So anyways, enough about that. Again, we're probably over time now anyways, and this is not going to be condensed, but Metaverse, what do we see? We're inside the balance, inside the balance range. So I'd be thinking about buyers stepping up around this area. Be looking for a counter trend move early on in the week. What's your key level for a lower high? I mean, right here at 498.85. If we can stop there, as we zoom in, this is where the buyers clearly failed to produce the higher low above for the inverted head and shoulders. We talked about this on that Thursday morning session, right? And even on Friday morning, as we opened above, we were like, okay, maybe there's some sort of constructive look here for a higher low from here to here. Well, unfortunately for Zuckerberg in the fantasy land, that was just completely, shot right out the door. So as of right now, as long as you're underneath that level on the higher time frames, I think the sellers maintain their edge. Once again, earnings on this one are a little bit earlier. They're Wednesday after the close for your Metaverse. Tesla, speaking of earnings, Tuesday after the close for Tesla and Elon Musk. This thing is just getting complete free fall, right? We've got this balance range breakdown. You can be my guest again if you want to be short down here. Not really ideal. It was not a clean breakdown. So in order to participate in Tesla, you would have had to been short from up here. This breakdown intraday, fine. If you're holding from there, that's great. But just a 2-day balance range, and then another gap down, producing a majority of the downside outcomes. Very, very difficult chart to trade. Do not feel bad if you've missed out on some of Tesla in here. I think that coming into a weekly time frame look is going to be fairly insightful. As we approach this low closer to 125, I would encourage you to just put your thinking cap on and say, is there an opportunity for longer term investors who want to buy Tesla at a discount? Are they going to step up at this known area of support? It's just a question to be asking. I'm not trying to say that this ultimately is going to mark some sort of mega double bottom and then, oh my goodness, Tesla's going to print new all-time highs. That's not what we're getting at. But just in terms of not wanting to be overly skewed to the downside here, it's an idea. So 125 is a zone. Next up, we've got Netflix, and I've got 2 additional trade ideas for you. This is still a weekly chart, so let's drop it on down to a daily, and then we will also take a closer look here. So Netflix reported earnings, and the earnings, as you can tell, I'm bringing up the trade ideas on the side here. Earnings gap down. So very, very holy chart, if you will, right now. We've got a big hole overhead, and we've got a big hole underneath us. So the name of the game on setups like this always is to just be patient. Let a balance range form in here, and then you don't have to be the first one in the door, but as we get into the range overhead, there's a potential idea to close the gap overhead. As in, if we drift in the downward direction, I would certainly be thinking about this level to the downside. How do you trade that? Probably on just lower highs underneath the earnings gap down range, which is here at 554.30. So overall, I think a lot of these charts look the same. I think, because of course they're concentrated in tech, and that's what the mega caps are right now. Again, just lower highs across the board there. Something that's not tech, something that you can focus on as an additional trade idea. HD, Home Depot. Love to see it, right? What do we see? Daily 50 SMA. This actually looked incredibly similar to the RSP, right? With an inside hammer on that Friday session. But anyways, inside hammer, 3 equal highs. If we can take them out, we've got thin structure to retrace. It would be a hold of the daily 200 SMA over 337.25, looking for a move into 346. 346 is the first thin structure retracement. And then technically, you could look for the move overhead to close this gap as well. Would this make sense if we get a risk-off rotation? I'm not convinced, right? Builders technically are more a part of the cyclical economy. Obviously not that Home Depot is a direct home builder, but you get the idea. In terms of home improvement, as interest rates move up, it's not really helping the cyclical side of things. So you would want to see interest rates maybe pull back a little bit. You would want to see more of that counter trend move in the S&P if you're going to get Home Depot to play nicely here over, once again, 337.25, 346 is your target. Then the next one is Coinbase. Coinbase is a rinse and repeat from earlier on in the week. One of the things we were talking about was the back-to-back hammers on Wednesday, right? And if we could take out these highs, looking for a lower high to be set here on the retest of 238, right? So you can clearly see on the Thursday session, let's actually take it down to the hourly chart. This is going to be really insightful. This was a double bottom, basically. That was your neckline. We looked over it on Thursday and failed inside. Look at the failure on Friday as well. We get this upper wick suggesting buyers attempted it one more time. Where do we close weak on the lows? This, of course, is nothing more than a bear flag now at this point. And even if we take out the Fibonacci's from the top, all the way down to the bottom, clearly we are consolidating underneath the 38.2. That, of course, is bearish, and we're looking for a move in the downward direction. So the idea here is that the failure of the buyers at this level to produce the counter trend to get here in the first place now just means we can look for the equal low breakdown underneath $208.50 into $193.50, and that, of course, is happening ahead of earnings. This is not a concern as of right now. That's all I've got for you in the weekly watch list episode for this week. If you enjoyed the updated format, you can let me know in the comment section. If you're like, Matt, you were all over the place today, I totally get it. I was trying to, thread together the narrative in one take here with no breaks, thinking of things as they were related. But if that was no good, you can also let me know in the comment section, and maybe we'll just go back to our normal format anyways. That's going to do it for today's episode. Once again, if you enjoyed it or learned something new, let me know in the comments section. Feedback is always welcome. We'll be live up in the Penthouse Studios at 8:15 Eastern Time on Monday morning, on Tuesday morning, on Wednesday morning, every day of the trading week. We are live for our pre-market prep. We hope to see you there. With that said, I wish you a green trading week.